Good afternoon, this is Bob Iaccino coming to you from the CME Group trading floor in Chicago, talking energy. Let's talk about crude oil. You have to talk about crude oil, down over 3.3%, almost 3.5%, 3.47% in toward the close, 66.77 near settlement. You got down as far as 66.32 all the way past 66.50, which is quite a big deal. That emotional level, that psychological level, I should say, and this is the biggest down day in crude since mid-July. July 16th to be exact. We are now down for the week substantially. If we were to finish the week lower, that would be 4 of the last 6 weeks lower in crude oil. And if you look at the chart, the down weeks, much bigger moves than the up weeks, the 2 up weeks that we've had over the last 6 weeks. Again, it's Wednesday, so we could reverse. It will be difficult to reverse all of this, though. A lot of this came off of the consecutive API and EIA numbers. Both reports showed the same draw-build mix between crude and gasoline. Big draws on crude oil when we were expecting builds. API was looking for a small build. EIA looking for a little bit larger build than that. They got draws on both. And gasoline were both expected to draw down and both built. Now, why would we fall so far off of that? Well, we didn't fall just alone off of that, but crude oil showed a 6 million barrel draw in API and a 3.8 million barrel draw in crude, where gasoline showed a 3.1 million barrel build in API and a 2.9 million barrel build in EIA. Now, why would that cause a push lower? Well, when you combine it with refinery utilization, RU jumped again, explaining in part why the inventory figures are behaving the way they are when you combine it with seasonality. We got 96.6 on refinery utilization. That's up from the prior number of 96.1. And then the week before that was about 93%. So when you see these jumping at this time of year, it could be one of two things. Number one, they could be building up gasoline stockpiles for refinery turnaround. And refinery turnaround consists of shutting down areas or sections of refineries to retool for winter blend gasoline, signifies the end of the summer driving season officially. Also, it could be reduced demand, and they've been building up those stockpiles and not getting the demand on the gasoline side of things. It could also be both. If it's both, it means much lower crude oil prices when everything goes back into full production, because the gasoline will be built. The refineries will not be pulling more crude oil out to do winter blend gasoline when they've got stockpiles of summer blend. They can't really sell that, but it's still in excess. So it could be a combination of both things. Either way, the gasoline builds with the refinery utilization number jumping again is definitely negative overall for crude oil. This is Bob Iaccino talking crude oil futures from the CME Group trading floor in Chicago.